John AG here, 31st of January 2026, and what just happened in the silver market is genuinely one of the most dramatic sessions I've witnessed in years analyzing precious metals. On Monday, registered COMEX silver inventories plunged nearly 5 million ounces while spot silver simultaneously exploded over 10% to smash through all-time highs, now trading at $118 per ounce. Physical inventories collapsing while prices break to never-before-seen levels. This is the kind of action that shows up when the paper pricing mechanism and physical reality are tearing apart at the seams. Quick heads up, stats show about 80% of you watching right now aren't subscribed. If this unfiltered edge is sharpening your view on metals and macro, hit subscribe. If not, don't. Plenty of mainstream channels out there feeding you what they want you to believe. This community digs into what they'd prefer you didn't see. Quick note, I'm active on X. Follow now, because I'm deploying advanced tools soon, and you'll want to be plugged in first. Drop OG John AG in the comments or hit like if you're getting value here. My team and I use that as a gauge, helps us know the real ones are here and actually learning. The COMEX depository report from Monday tells a story of absolute chaos. ASA received 295,000 ounces, but had 111,000 adjusted out of registered. Brinks lost 411,000 withdrawn, with 1.14 million adjusted out of registered. CNT saw 664,000 withdrawn and 3 million ounces adjusted out of registered. HSBC reported 301,000 withdrawn with 52,000 out of registered. JP Morgan saw 1.93 million withdrawn and 248,000 adjusted out. MTB had 1.093 million withdrawn with 72,000 out of registered. StoneX lost 118,000 from registered. Total registered silver dropped 4.73 million ounces to just 107.6, 67 million ounces. Total COMEX silver fell 3.46 million ounces to 411.68 million. The registered category is metal actually available for delivery against futures contracts. In 24 hours, it lost 4.5% of its base. Here's the critical part. While this physical drain was happening, silver didn't collapse. It exploded to 108 tiers, breaking all-time highs. Gold surged to a new record above $5,400 after Powell's speech, adding over $1.1 trillion in market value in a single day and $7 trillion total in 2026. That's up nearly 24% in just 28 days. Connect the dots. Physical metal is being pulled from registered inventory at panic-level pace. Yet prices are surging to historic levels. This is not supply abundance meeting weak demand. This is entities pulling physical because they believe the paper price is failing to represent true value. They're converting claims to metal and getting it out before something breaks. Let's talk the Federal Reserve catalyst. The Fed held rates at 3.5 to 3.75%. Before the FOMC statement, gold and silver got smashed in classic pre-announcement suppression. Then Powell spoke and metals went vertical. Why? Because Powell admitted U.S. debt is not unsustainable, but the path of U.S. debt is uncontroversially unsustainable. The head of the Federal Reserve just told the world that the trajectory of American debt is unsustainable without controversy. Not debatable, uncontroversially unsustainable. After years of assuring markets everything is controlled, the chairman is openly admitting the debt path cannot continue. Peter Schiff nailed it after the press conference. When asked about dollar weakness, Powell said the Fed doesn't comment on the dollar because its job is monetary policy. Schiff's response, the dollar is money in the United States, so how can the value of our money be irrelevant to the Fed? The institution responsible for monetary policy claims currency value is outside its mandate. That tells you everything about how broken the logic has become. Now add geopolitics. Trump issued a statement to Iran. Hopefully, Iran will quickly come to the table and negotiate a fair deal with no nuclear weapons. Time is running out. Make a deal. Whether you agree or not, what matters is geopolitical uncertainty is escalating, not subsiding. Middle East tensions, nuclear negotiations, potential conflict, all drive safe haven demand and reduce confidence in paper claims. Here's what I think is happening beneath the surface. The COMEX operates on fractional reserve. Not every contract holder can take delivery simultaneously because there isn't enough registered metal. The system works when most close positions in cash. But what happens when that breaks down? When registered inventories fall this fast while prices break all-time highs, it suggests major entities either believe 118 is a bargain and want metal before it climbs higher, or they no longer trust the exchange to deliver in stress. Both are bullish. The first says smart money accumulates at record prices expecting much higher. The second says trust in paper is eroding, and physical is being hoarded outside the system. There's a third possibility. What if large short positions are being challenged by entities demanding delivery rather than cash settlement? Shorts must either deliver metal they may not have or buy it physically, which drives prices higher and drains inventory simultaneously. That's a squeeze, and it accelerates exponentially because each delivery buying which raises prices, which triggers more demands. Silver at 118 means we've officially broken all historical resistance into uncharted territory. When an asset breaks above all-time highs, there's no overhead supply from holders waiting to sell at profit because nobody bought higher. We're in price discovery mode, no historical resistance, no reference point. This is where parabolic moves happen because the market figures out in real time where selling overwhelms buying. Gold at 5,400 making repeated all-time highs with 24% gains in 28 days is extraordinary for a multi-trillion-dollar asset. $7 trillion added to gold's market cap in 2026 alone, more than Japan or Germany's entire GDP. That's real capital flooding and faster than markets can absorb smoothly. Now the bearish case, because I don't sell hopium. First, if the Fed turns hawkish or inflation softens, you could see profit-taking as real yields rise. Second, if geopolitical tensions de-escalate quickly, safe haven bid diminishes temporarily. Third, technically silver is extremely overbought after breaking all-time highs. RSI is in extreme territory, momentum stretched, and we could see sharp pullback to consolidate before the next leg. Fourth, falling COMEX inventories don't guarantee imminent default. The exchange has managed stress before. They can raise margins, limit positions, encourage cash settlement, find metal overseas. The system has flexibility. Fifth, even if physical shortage is real, it could take months or years to fully manifest. Markets can stay disconnected from fundamentals longer than traders stay solvent. But every bearish point is short-term tactical. They don't address structural drivers. The Fed admitted unsustainable debt path, meaning either cut rates and let inflation run to devalue debt, or hold rates and watch debt service spiral until fiscal breakdown. Both outcomes are bullish for hard assets. Geopolitics may fluctuate, but the trend is toward fragmentation and less dollar system trust. That's structural. Industrial demand isn't disappearing. Solar, EVs, AI, data centers, 5G, military applications all require silver. Real induced consumption, removing metal permanently. Supply side shows no major new discoveries offsetting depletion. Grades declining, energy cost rising, permitting, extending. Much silver comes as byproduct of base metals. So, if copper or zinc prices fall and mines cut production, silver supply falls regardless of silver prices. That's a structural deficit taking years to resolve. Here's the reveal that reframes everything. What if Monday's COMEX drain isn't isolated, but the beginning of sustained paper market deleveraging? For decades, futures have been primary price discovery. Spot prices derive from COMEX futures, not physical transactions. But if futures lose credibility because registered inventories fall and delivery concerns rise, where does discovery migrate? It migrates to physical. In physical markets like Shanghai or retail premiums, silver has traded at significant premiums to COMEX for extended periods. If discovery's center of gravity shifts from paper to physical, price must adjust upward to reflect actual deliverable scarcity. The 10% surge to all-time highs isn't just momentum. It's re-rating what silver is worth when you strip away leverage and fractional gains. Think nickel on the LME in 2022, spiking to over 100,000 per ton when a short-faced squeeze and the exchange halted trading. Cocoa hitting all-time highs as physical tightened. Uranium going from 30 to over 100 as utilities realized spot couldn't supply volume needed. In each case, price discovery broke and reset higher, reflecting physical reality versus paper leverage. Silver has all the ingredients. Futures with declining registered inventory, physical with structural deficits, macro where fiat credibility erodus, geopolitics favoring safe haven hoarding, and now breakout to all-time highs, forcing everyone who thought 120 or 150 impossible to reconsider assumptions in real time. Historical parallel, heavily qualified in 79 to 80. Silver went from $6 to $50 in months, driven by Hunt brothers, inflation fears, Soviet tensions. The rally ended when exchanges changed rules, raised margins, forced liquidation. The lesson isn't we repeat that pattern. The lesson is silver moves with breathtaking speed when physical demand overwhelms paper supply, and authorities intervene if they perceive systemic risk. Today's difference accumulation isn't two billionaires, but distributed across central banks, sovereign funds, industrial users, millions of retail stackers globally. Much harder to target. Inflation isn't just American, but global debasement affecting every fiat system. Geopolitical fractures involve China BRICS, Middle East conflicts, genuine dollar hegemony challenge that didn't exist in '80. So where are we? Silver at 118 making all-time highs. Gold at 5,400 making all-time highs. COMEX registered down nearly 5 million ounces in one day. Fed admitting unsustainable debt. Geopolitics escalating. What's the playbook? If you're a long-term physical holder, don't panic. Sell into the rally. The structural case is strengthening. Higher prices improve mining economics, but there's multi-year lag. Meanwhile, industrial demand is inelastic. Solar manufacturers can't stop buying because price rose 20%. They need it. Same for electronics, EVs, medical. This isn't speculative mania. Real users competing with investors and governments for finite supply. If you're a trader, respect volatility and manage risk religiously. 10% daily moves can go either direction, especially after breaking all-time highs. Use stops. Don't overlever. Don't chase after massive spikes into new territory. Wait for pullbacks. Understand momentum indicators can stay overbought far longer than seems rational. The trend is your friend until it's not. But fighting this strength without clear reversal signals destroys capital fast. If you're on the sidelines, I can't tell you what to do. That's your decision based on risk tolerance, time horizon, conviction. What I'll say, opportunity cost of staying out, when fundamentals are this compelling and we're breaking all-time highs, is potentially higher than risk of short-term pullback if you enter in dollar cost average. But that's your call. Do your due diligence. Here's what I'm watching. First, do COMEX inventories stabilize or keep falling? Continued drops escalate delivery concerns and widen premiums. Second, Shanghai premium to COMEX. Does it expand or contract? That spread shows if physical is tighter in Asia than futures reflect. Third, ETF flows. Is institutional money piling into SLV or PSLV or still skeptical? Fourth, geopolitical developments. Any Middle East escalation, Iran negotiation breakdown, new sanctions adds fuel. Fifth, the dollar. Powell may say Fed doesn't comment on it, but dollar value is central. If it weakens as debt concerns grow and foreign holders reduce treasuries, that's jet fuel for commodity prices. If it strengthens on safe haven flows despite debt concerns, that's headwind. One more thing, people ask if this is a bubble, if we're near a top, if smart money is out. Here's my answer. Bubbles show euphoria, universal participation, leverage extremes, fundamental disconnection, widespread belief prices only go up. We're not there. Most mainstream investors own no silver. Most advisors recommend zero precious metals allocation. Leverage is contracting as registered inventory falls and margins could rise. Fundamental justification, industrial deficits, monetary debasement, geopolitical fragmentation is stronger than almost any point in 2 decades. Can we have sharp correction? Absolutely. Are we going straight to 200 or 300 without pullbacks? No. Markets don't move in straight lines. But calling this a bubble top at 118 when we just broke all-time highs, structural case accelerates and the monetary system admits unsustainability is probably premature. Bubbles top when everyone is Allen and leverage maxed. We're not close. 3 key takeaways. First, COMEX registered dropping nearly 5 million ounces in one day while prices surged over 10% to break all-time highs at 118 is a historic signal of physical paper divergence. This is stress. Second, the Fed chairman admitting U.S. debt path is uncontroversially unsustainable is a watershed for hard asset demand. When the central bank acknowledges the system is on an unsustainable trajectory, that's your signal to own assets outside it. Third, gold making new highs above 5,400 while adding over $1 trillion in market cap in a single day shows this isn't fringe. This is global capital repositioning for a world where fiat credibility is questioned. The unresolved tension. Can COMEX and LBMA continue functioning as primary price discovery if inventories keep draining and credibility erodes while prices break into uncharted territory? If no, we'll see a reset that makes 118 look like early innings. If yes, and they stabilize, we'll consolidate and grind higher slowly. I don't know which outcome we get, but I know which I'm positioned for. And the risk-reward at current fundamentals favors holding physical and being patient. Do your own research. Verify everything. Challenge assumptions. Don't invest based on hype or fear. Invest based on logic, data, clear understanding of risks and opportunities. And remember, I will never ask for your money. Never pitch invest with me. Never run paid signals or funds. Protect your capital and stay far away from anyone using my name to scam you. Invest with logic, not hype. OG out and about.